Let's shift back. Maybe Herman, you could comment. You were indicating that there was a wide range of performances among your managers in the first quarter. Maybe you could highlight a couple of sectors that didn't do so well and some that did well, just to give us a feeling as to, because you probably see the broadest range of managers among the group here.
Yeah,
Thanks.
I mean, I think Tom would probably cover the broadest range of managers, but agreed, it's a broad range. I would highlight a couple of things with respect to performance, the extremes, and the extremes were all related to what I'd call more exotic equity vol related relative value strategies. So if anyone was, if you ran historical analysis going back as far as you can possibly go, the short S&P versus long Asia, long European equity index vols would have behaved as a long vol proxy during a crisis like we've just witnessed. So when you think about risk management and you think about those inputs into it and sizing of trades, a lot of people got caught on the wrong side of that trade where they were funding the cheap longs in Asia and European equity index vols versus being short US S&P vol. Mm-hmm. Right, so that behaved. That wasn't just it didn't only not behave as a long vol proxy, but it actually behaved the exact opposite and by a factor of 10. So it's very difficult to handicap those types of moves. If that strategy was within a multi-strat, those managers were able to weather the storm. If that was a standalone strategy, we read about some of the bloodshed in some of those managers. In terms of within the macro space, there was also dispersion, specifically as it relates to more developed market focused managers versus those that were more emerging markets focused. Obviously, the latter underperformed significantly in some cases. Were good, down double digits. That being said, a number of those managers have recouped probably more than half of that already in April and May. And it looks like May is looking to be a good month again for those managers, especially ones that are long Argentina. We've seen those bonds. If you take the barbell approach, 2028s versus the century bonds in Argentina, those have rallied from the low 20s. Those are now $34 and $32 respectively, or thereabouts. So there's been a nice material recouping of those losses. Within developed market macro, most of those managers have done pretty well. They were able to capture, in fact, some of them were long equities in January. Some of them had the foresight to reduce their equity exposure. There was some real opportunities in the front end of the rates curve where things were clearly mispriced, not pricing in a much more aggressive Fed. Those options were still very cheap. Managers that were able to capitalize and buy some of that cheap optionality and monetize those during March and did very well. And we've read some of the headlines. So, within our book, very mixed bag. Like I said, a lot of dispersion, but net, our macro book held up pretty well. There was one manager in particular that did extremely well and is up about 50% or so year to date, and that's a systematic commodity manager. As I mentioned at the beginning of the conference, we thought markets were going to become more volatile, and we started positioning. And I guess the first question you asked, I should have really answered that more clearly with respect to the structure. So we have a Titan Emerging Managers Fund, which the sole purpose there is to allocate to smaller and nimble managers, sort of along the lines of what Tom has talked about. I'm in agreement. I think big is bad, and it's not great for alpha. And so we set this up back in 2005, well before I joined Titan, obviously. And we've got a number of managers in that Titan Emerging Managers Fund, and we got a number of long short. We got a number of macro managers in there. The long short guys did not do so well through March and April, doing okay here in May. But the macro managers in that fund that we have slated to get upsized across the board, unfortunately, I say unfortunately because we didn't upsize them, did extremely well. So they've been up every single month this year. They were up over 2% in March. They were up almost 3% in April as a collective group, and are up about the same here in May. So they've done very well. One of those is the systematic commodities manager that I mentioned.
Yep.
Another one is a macro manager based in Singapore, and they've been able to capitalize, the macro manager that is being able to capitalize on some of the moves in foreign exchange and in rates.
Okay. Being a specialist in the commodity area, I have a feeling I know which manager that is in the commodity, a Midwest one, right?
No, it's not Midwest.
Oh, okay. Well, there's another one there. So Marat, in the CTA space, was it the short-term managers that were able to outperform, or with the daily swings in the market, did those guys get beaten up as well?
Great question. First, I'd like to, Michael, I'd like to say I'm very happy for you. I know that it was a very difficult market environment in commodities for a few years, and I think that I want to give credit to Herman and others who actually were able to stick it out and focus on diversification, because I think it's really difficult to predict which strategy is going to do well. And when you look at this year, actually, there are lots of things that changed from what we've seen for the last few years. For example, commodities have done extremely well. I think that's a really great environment. But I think, unfortunately, a lot of investors have not been able to stick it out. So I give credit to Herman and people like him who actually said, you know what, we believe in diversification, and even though performance has not been as great lately, we believe that this manager, this strategy belongs to our portfolio. So credit to him, and I'm happy for you, because I know it's hard to wait when the market environment is so difficult. So what we've seen is that commodity managers actually have done well. Short-term managers have also done well. But, I guess what would be helpful to do is to kind of step back a little bit and talk about how we look at the universe of CTAs. Because a lot of people are not familiar. So CTAs is a subset of hedge funds. It manages about $350 billion, which is roughly 10% of hedge fund assets. CTAs are known for crisis alpha. We love volatility, and I think when we talk about the whole idea of return dispersion, and like as Thomas was talking about what he expects going forward, I think there's a difference between an initial shock, and that's what we saw in Q1. So I would compare it to an earthquake. An earthquake comes and it's unexpected, and I think there's so much luck that shows up. So some managers do well, some managers do poorly, but all that is heavily driven by luck. So ironically, as we talked about implications of this whole crisis for manager selection, we're trying to figure out how do we actually adjust our quantitative approaches and quantitative evaluation system to be able to account for this spike, because it was so strong, so significant. Anyway, okay, so we have, when we look at the universe, we have long-term trend managers, and those are highly correlated managers. They have the majority of assets in our space. They're known for providing crisis alpha. And as I mentioned earlier, there's a lot of dispersion even across those managers. That's why, in general, we believe in diversification. So what we find is that if you invest in 5 or 6 managers that are highly correlated, then idiosyncratic risk goes down, and you're able to improve your performance by about 20 to 30% relative to only having 1 or 2 managers. Now, it sounds obvious to you. At the same time, we find over and over that a lot of sophisticated investors choose to have only 1 or 2 managers, and sometimes, just because of idiosyncratic risk, they get disappointed. So actually, we wrote a P&I piece that came out earlier this year, and it talks a lot about the idea of diversification within CTA space. So, you can either find it online, or if you shoot me an email, I'd be happy to share a copy with you, because I think there are a lot of misconceptions that investors have, and we try to address those misconceptions with some hard data. So quickly to touch on what drives dispersion returns. What happens when we talk to a lot of managers, they make really smart decisions. They're very thoughtful about the type of signals they use, the type of position sizing they use, the type of look-back periods, the type of sector allocation. But we also find is that even though each of those decisions is a reasonable decision, the outcome heavily depends on the market environment. So, for example, if somebody had no allocation to commodities for the last few years, they would have probably outperformed the industry on average. At the same time, they would have really struggled this year. So market environment is important. Also, if you look at different look-back periods, for the last 10 years, since the financial crisis, we've seen quite a few dips that actually never turn into a bear market. So people say, well, there's a dip, you're going to buy, right? And those managers who had shorter time frames, such as short-term managers, Michael, as you mentioned, they really struggled because whenever it seems like markets were turned around, either the Fed jumped in or something else happened, the markets flipped back on, they get chopped. And a lot of people said, you know what, we're disappointed with short-term managers. If you look at the SocGen short-term managers index, it really struggled over the last 10 years. So people just walk away from the space. We've been dedicated to keeping that allocation fixed because we believe in diversification. We have also been very fortunate to substantially outperform the industry in the short-term space. So our experience was much better than SCTI index. And we've seen that short-term managers really benefited a lot from this environment because they're able to reverse their positions much faster. So if there's a big move that happens within 30 days, those managers who are able to react faster are able to benefit from those moves. Finally, we have a third bucket, which is called diversifiers. And those managers are very unique, very highly idiosyncratic. So there could be, like in your case, Michael, could be some market specialist in commodities, somebody who trades grains and lean hogs, or it can be somebody who specializes in a particular FX market, right? They really, try to track what happens in the FX space, maybe apply some relative value strategies. And when you look at those strategies, they're highly uncorrelated to each other. And the role in our portfolio would be not necessarily to produce crisis alpha, because that's the role of long-term trend and short-term managers, but actually be able to add additional alpha that consistently improves performance for our clients, year in and year out. So in terms of return dispersion that we've seen in that space, it's very high. Ironically, I think our experience is somewhat similar to what Herman said. He talked about relative value strategies. So we've seen that some of the strategies that perform really well, really poorly, were either some type of spread strategies or some type of relative value strategies. And I think the verdict is still out there to figure out whether it was skill or luck. I would argue that there was actually a lot of luck involved. So we need to be careful a little bit more at how we approach evaluation of performance in Q1. Next month, our CIO is going to give a webinar, and he will go into detail. He's going to give a lot of information to explain what actually drives return dispersion in diversifiers and other strategies. And just to give you a quick teaser, we find that even changing the look-back period by 4 days for some strategies would have resulted in 400 basis point performance improvement in Q1.
Anyway, Tom, tell us a little bit about where maybe we start to look forward here. Where do you see the opportunity set? Looking ahead. I mean, are you're not trying to predict the market, but are you expecting, like we are, sort of a continued volatility and maybe selecting managers based on that kind of a perspective?
Yeah, well, let me first talk about the commodities managers, because the three of you have spent a little bit of time talking about that, and I'd like to just chime in for a moment about that. Let me just say that I'm willing to bet that I've been in the commodities market longer than anybody on this panel. I got my Series 3 in 1981, and it was a commodity trading advisor, commodity pool operator. And today we have no allocations to managed futures managers. Over the years, an industry that is focused on long-term trend following, I think, has been a very frustrating, asset class, if you want to call it that, to invest in. It's sort of like 9 months out of 12, it is either flat or negative, and 2 or 3 months out of 12, it performs well. And so you're always saying, in the 9th month, why do I have an allocation to these things? And in the other 3 months, you're saying, why aren't I not bigger in these things? And you're never in the right place at the right time, it seems to me. And so I'm a big believer in what Typhon and what Dorset does, which are these idiosyncratic, non-long-term trend following managed futures managers that specialize in grains or livestock or whatever, and combining those together. We don't have, as I say, an allocation there, and we've looked hard at Typhon and endorse it, and I think that at some point in the future we'd like to have that allocation, because there's no question in my mind it's idiosyncratic, it is uncorrelated to everything else, and I think there's a place for it in the portfolio if it's designed intelligently, as I know you guys do. As it pertains to the opportunities that we see going.
Thanks, by the way.
Yeah, he didn't pay me for that, actually. The opportunities that we see, I mean, this is an alpha-driven industry. Okay, so beta is an important part of the markets and of investment management, but so is alpha. But you shouldn't confuse the two. For example, we have an allocation to energy, and we all know what happened in April with negative pricing on crude oil. It was just an absolutely bizarre market environment, and I think that because energy has been so challenging, there are a lot of allocators who don't want to allocate to energy anymore. They just won't listen. When I talk to friendly competitors, they're like, forget about energy. We're not doing energy. And I think that part of that is it pulls the veil back and exposes a lot of allocators for their beta tendencies as opposed to their alpha tendencies. We've done well in energy over the last 6, 7, 8 months, even though, as we all know, it's been a very challenging environment. It has to do with having idiosyncratic alpha. It has to do with having a contrarian perspective on the markets. So what we look for, if spread widening and disrupted markets are the lifeblood of alpha strategies, because spreads widen and there's weak hands that are forced to sell. Natural buyers in, let's say, municipals are selling because they're in mutual funds. That is an environment that's rich for alpha production over the course of the next, call it, year or two, because of those disruptions.